All right, guys, welcome to the show. We always enjoy talking to people about what to do with your money, and that's always going to be interwoven with your tax strategy and wealth building ideas, obviously. So I'm excited to have someone who has instructed and implemented very well in this topic. I'm here with Christina Wise. Christina, why don't you introduce yourself in 60 seconds or less, and let's get into it.
All right. Yeah. Christina Wise, and I am the founder of Wealthy Wealthy, and we're a financial education coaching company. So we teach entrepreneurs how to maximize their inflow, their income, but then how to convert that income into long-term lasting net worth and wealth that ultimately turns into passive income. So I like to really teach the difference between income and wealth. So I think that's a lot of what we're going to talk about today.
Okay, so tell us, what is the difference between income and wealth?
Well, perfect. I love that. Just to get us started, I love the question. Since I'm in the money business, funny enough, I'll go give some background, but I know you're a CPA, and I went to accounting school and I got an accounting degree, and I was sitting for my CPA, and I was working for a big six accounting firm at the time, just straight out of college. And a couple things, like right off the bat. Number one, I learned that for me personally, I didn't want to be in corporate accounting.
Can't blame you.
And so that led me on more of an entrepreneurial journey. But the second thing, and I think more importantly, is I went to college to learn money and learn finance, and I got a double major. I was a finance major and got a finance degree, and then I went on and took that extra year for accounting and got an accounting degree. And I got those degrees because I wanted a business degree and I wanted to focus on money. I was just really interested in money at the time. And I got those degrees. So now let's fast forward about a decade, and I wind up in a situation where I'd made a lot of money, but I was completely broke, where I was just one step from filing bankruptcy. I had over six figures of debt, and I had tax liens, and my personal financial situation was a nightmare. Single mom, couldn't pay bills. I mean, I literally didn't have money to put a deposit to turn on the electricity at the time. And it was just this head scratcher, because I thought, how the hell did I basically, had a CPA behind my name? I just, didn't finish taking the exam. I'd studied for it and had all this education and was making a really high multi-figure, six-figure income. And I wound up completely broke. And I couldn't figure it out because I studied money and then soon learned that what's taught from more of a corporate point of view when it comes to money and finance does not translate to personal finance. And that got me to this place of wondering why I made so much money, but I was completely broke. And that's where I discovered that because income and wealth are two radically different distinctions, yet they get conflated all the time. So to answer your question, is income is the money we make, and it's money that's incoming that is either active income, meaning we work for it, or passive income, meaning it comes in from non-working income. But income, as you know, being a CPA, it's reflecting on something called a profit and loss statement. And that can be in business finance. So if we're entrepreneurs, we understand a profit and loss, and we're really trying to maximize that profit. But I also teach a concept of a personal profit and loss, that you run a profit and loss for personal finance so that you can see, is your household profitable? And if your household is profitable, which is the goal of household finance, unbeknownst to most of us, it's the same goal as business, is we need to be profitable as a business. That's the goal. So the consistency here is profit. And that, again, that's represented in the form, it's on a profit and loss, but really that's the form, it turns into income, because that profit is what we pay ourselves as entrepreneurs. Now, as a business, now our profit in our household, that's money that's sitting there. But the idea is that we turn that money that was a portion of our income, and we create wealth out of it. Wealth is reflected on a balance sheet. And in business finance, wealth is any form of asset, basically, some type of, has economic value to the business, and that sits on our business balance sheet. And we need to look at our business balance sheets because we want owner's equity and we want to build enterprise value of the company, which would be, we don't call it net worth for a business, but it's like the business net worth per se. But then in personal finance, and the reason why I'm saying this is because they're equivalent. If we think the same, I think kind of in business terms for personal finance, is that we want our personal balance sheet that reflects our personal net worth. And our goal over a 40-year working career is we want to maximize our income and make as much money as we can, but we will always want to take a portion of that income and turn into wealth. And wealth is asset value. Wealth is something that sits on the balance sheet that has value, that either creates passive cash flow from the interest or like rental income, maybe a rental profit from real estate, for example, or interest income that might be in the form of dividends and more traditional type investments. But ultimately, over our working career, we want to grow our income and we want to simultaneously grow our wealth. So it's just understanding these two things are different. And as we grow our wealth over a 40-year career, at some point, we want that wealth that replaces our working income so that we don't have to work anymore. And that's called financial freedom. Some people call it retirement, whatever word you want to give it. But that's the difference, is they're reflected on the simple way to think about it is they're reflected on two different financial statements. But two, we don't want to just focus on income at the expense of not thinking about wealth. And I call that high income rich, as I work with so many high income earners, but they're still paycheck to paycheck. They still have to work next month to pay last month's bills. And that's just what I call the money trap.
Mm-hmm. The gold or the golden handcuffs, and especially if you're looking to have a second stream of income, and sometimes if there's risk involved, if there's not enough cushion, not enough room to take risks, then you're going to kind of be stuck on this treadmill of doing the same thing and just not a whole lot of movement in your finances. So, and I think that now so when you think about this, are you talking about full-time entrepreneurs? This is a big issue. I imagine with all Americans. I mean, our country has a history of buying things they can't afford, but the misperceptions here in how people are going to be spending more than they need. When you look at this, do you help people attack this as entrepreneurs or W-2 folks or a little bit of both or part-time entrepreneurs? What kind of people do we see overcoming this?
So I mean, everything that I'm talking about is fundamental. I mean, it's
Hmm.
applicable. It's just money fundamentals, the money basics, and it's the way money operates. And if we don't understand how money operates, money's always going to control us versus the other way around. And basically, it's a lack of understanding of how money
Hmm.
works at the basic level. And again, we need income, we have expenses, but we also have to build this thing called net worth. But there's an over focus on income in this country because it's like we value ourselves, or we get valued based on how much money we make, based on how we display how much money we make, by the cars we drive and by the houses we live in and by the neighborhoods and by the types of vacations and so on and so forth. So really our value is based on income. And like I said, in that display of income, because wealth is more private. And I'd like to talk about it, the difference between riches and wealth. And again, it's the difference between income and wealth is the same difference between riches and wealth. And we can look rich and we can feel rich when we have a very high income. Why? Because that high income affords us a rich
Hmm.
lifestyle, the emblems on the clothing, the bags, the cars, the shoes, so on and so forth. But that doesn't mean we're wealthy. And that's when we go into wealth is private and it's not obvious. So if I might have $10 million in net worth, for example, but if I drive a Honda, the outside perception is like, oh, if she drives a Honda and lives in a middle class neighborhood, then that's the association, or that's the assumption. So wealth isn't obvious. Wealth, because you can't see my financial statements, you can't see my bank statements, you can't see how many assets I have because it's not displayed
Yeah.
anywhere. So that's where it gets really confusing. So to answer your question, is that that I primarily work with entrepreneurs because I am an entrepreneur. And the reason why is because entrepreneurs tend to have variable income. We have high months and we have lower months. We have higher months and lower months. And so managing your money, very few people manage their money or manage their money well. But it's more important that for as entrepreneurs to manage their money because there is no fixed amount. And so you have to manage your income and your expenses relative to your income to make sure that you are growing wealth, and it's harder. And that's why I like to focus on entrepreneurs. And entrepreneurs are so focused on income, they're not paying attention to wealth. They're just focused on building their business. And usually they invest too much money into their business at the sake of building personal wealth. But yes, it's applicable to W-2 earners as well.
Yeah, absolutely. And I feel it too. Sometimes with all the volatility in our business and certain months being more lucrative than others, it's hard to think to yourself, okay, how much money am I actually making this year? Like what is my actual profit looking like? So we're some to an entrepreneur who's just getting started, right? So what are some first key actions they can do to start thinking about, budgeting for investing and wealth and making sense of all their numbers to identify, what are some things they can look at to start making some decisions on, okay, this is what we're going to set aside to invest. This is going to be what we have liquid for, covering payroll. What are some of the first steps that they can start thinking about?
Yeah, there's a few different things. First of all, start fundamentally and more mindset. And like I said, the first thing that I really like to emphasize is that whether you're W-2 or entrepreneur, but in this case, entrepreneurship. And the reason why I like entrepreneurship too is because we do have a lot more control over our income and our
Mhm.
earnings as opposed to being a W-2. So that's why I like entrepreneurship. Like there really is a lot more opportunity when it comes to our creativity, our hard work, and our knowledge as we become better business owners and marketers and the different things that business ownership requires. And there is no real ceiling to that income. So I love that because again, if we want to make more money, we can make more money by becoming better at business. So, but on the entrepreneurship side, the mindset and the understanding is I like entrepreneurs just to take away if they're just starting or no matter where they are in their business is like I said, is this realization that yes, I need to grow my business and I want to build that business to a certain size or level, but also I need to build my wealth. And that's what I like to take away. So again, we're building these things simultaneously. But to get started, I like to talk about what I just call a profit first mentality. It's nothing new. We've heard profit first for a long time. But whether you're just starting or, if you're just starting, to start with a profit first mindset means that
Mhm.
I'm always going to be focused on profit. And what entrepreneurs focus on is creating sales, creativity, building the funnels, making more top line revenue, selling more units. How do I grow the business? And they're not paying attention to the cost of that or how much they're capitalizing into the business and what they're doing. And so many times new startups, they'll go years without any real profit and they're robbing themselves. So that's the first thing is just to know, like, whether I start at, $50,000 a year revenue, I'm still going to keep a 10, 20% profit. Whether I'm if I get to six figures, I'm still going to do a 20% profit. When I'm seven figures, I'm still going to focus on that 20% profit. But it's really just changing the focus as we get into my job as a business owner is to create profitability because that's where I pay myself as opposed to just paying attention to revenue.
Yeah, there's um, we have several people in our communities focusing highly on the profit first methodologies and setting aside money for taxes and stuff. For us, serving real estate investors is tricky because sometimes these guys they don't know whether or not they're going to close on a rental property before the end of the year, and if they do, then that may impact their taxes by amounts in the hundreds of thousands. So it's a little tricky, but I think there still is a way to do it, and in particular, just if you want to over budget for your taxes, if you're uncertain if certain things are going to go through, to at least make sure that you set aside a certain amount for profit and taxes and all your other expenditures. But we've seen a lot of people who've done profit first, and because of that, they've seen their businesses skyrocket because it gave them so much more clarity on what they were doing with their money, and not only their business and income, but also what we're talking about here is their wealth.
Yeah, and real estate, I'm a real estate investor, so real estate investing is no different. And again, it's just thinking in these different containers or boxes. So when it comes to if we're a real estate investor, sometimes that can get confused with that's wealth. But as a real estate investor, that's our business. Our business is like I'm a real estate investing business. So how I make income is through this business. And so first is getting clear on what is my business and how does the business make money. And so there's two ways basically to make money as a real estate investor. Is the one is focused on income, big chunk of income, so annual income. And especially when a real estate investor is first getting started. So how do you make an annual income of $100,000, for example, as you're getting started as a real estate investor? Well, the way to do that is you're going to have to flip houses because you're going to take the margin between what you paid for it and the money you put into it and then what you sell. And then that's going to be a big chunk of business. And so we don't get paid until we sell something. But when we sell something and that house sells, then we're putting money into our business account and, we're paying all those bills. And the reason why profit first is really important as a real estate investor who's flipping basically is that you need to have money there because we don't know how long that next cycle is going to be before we're going to get that next chunk of income. And let's just say you're doing, 1, 2, or 3 deals a year to earn that 6-figure income, and is an example. So it's really important because that money can be eaten up so quickly and not part of my tax liens back in the day is because I didn't save money from taxes and I thought I'd pay the taxes in the next deal and the next deal. And finally it caught up with me and the IRS wasn't too happy and came down on me pretty hard and realized like, oh, okay. But after every paycheck, it's like, you work with you and your CPA and like, okay, guesstimating what percentage of should I be putting away for taxes, and you have your tax bucket. But you also, which means a tax account that's separate than your operating account. Then you're going to take out like your 10 or 15 or 20% profit, and you're going to take that out. Then you're going to take out a portion of what I call other people's money because there's going to be other people you probably have to pay in there somewhere. Maybe you owe somebody some money that you have to pay back out of that type of sell or future sell. So the idea is the point here is to really to maximize the profitability and make sure that 1, you keep a profit, and 2, you have enough money to pay all the bills and pay everybody else, including the IRS. You have to account for every dollar and really pay attention to the money in your business. And every dollar has a job. And that's why, is it a tax job? Is it a pay Krisstina profit job? Is it I'm going to have to pay other people back job, or is it to cover the expenses job? So that's, again, it's just really important that to understand that it's not just about finding the next deal and scouring the market and sending out the letters and doing all the things. It's about managing all the money also, and not just, worrying about the money later. So that's kind of the big takeaway. But then what happens is that then when we pay ourselves, let's say out of this deal, we made $100,000. Let's say that there's, I don't know, $25,000 profit out of this deal. We're going to move that $25,000 to our household. And now we need to move, same thing. We're going to bucket that money, and 10, 15, 20% needs to go into maybe an asset bucket where we're going to use that money to maybe have a down payment or something on the next deal. So you're constantly moving your money and managing it, but it's just to understand that in real estate, as a real estate investor, that's the one way we make money, but that's income. That's, we're managing the capital gains. We're managing, it's flipping, and we're making big chunks of money by selling and flipping out of one property to another and keeping the margin. That's different. The other type of way we make money as a real estate investor is where it's the buy hold strategy. So that's not about getting a big chunk of money now. It's more about cash flow and building that net worth and building that asset base that we're going to make smaller amounts of money based on cash flow, that if we, buy it right, and now we can have, our rental income minus all the expenses, that's the profit of managing those assets. Now that might be, let's say $1,500 a month net, and that's very different than getting, a big chunk of six figures. So what I've always done as a real estate investor, one, it's like I said, you manage every dollar. But while we're making that $100,000 in income through flips, we also want to build that net worth that's going to be that portfolio of real estate that we keep over time, that creates that passive cash flow through the net income that comes from the, out of the rents. And ultimately, once we build that portfolio then matches our lifestyle costs, basically, and then we don't have to flip houses anymore. So that's what I've done over my real estate career, is that, I did maybe one or two flips a year, just based on the economy and what I was doing. You sometimes just maybe a flip every couple of years, but I would be doing the flip so I could get a nice big chunk of cash if I found the right deal. But my primary motive was always to build that portfolio, that I use that portfolio today, that I basically, get to live semi-retired and do what I do now. And I get to teach how I've done it. But the idea is that it was a both and strategy. I was focusing on using real estate to make income, and I was focused on real estate to build long-term wealth.
Yeah, so, and then when it comes to measuring not only your income, but your wealth, here's where you have to do some deeper analysis to make sense of the numbers. Because when you're flipping, we get these people, we've had some beginner flippers where they have let's say $100,000, $200,000 profit on the flip. And they're like, well, I got all this profit and I want to pay taxes on it, so I'm just going to buy another property to flip. And they don't realize that this is inventory that is capitalized, and there's no tax deduction. And you'll only get to deduct the taxes on it is when you sell it to offset your additional revenue. So if you haven't set aside money for taxes from this flip, you might find yourself in trouble. So now we're at a point where let's say you put your money into this more inventory that is, and hopefully you're using leverage, so you still have liquidity here. But you're often going to find that the tax measure of your profitability is greater than the amount of cash you're retaining from your flipping business. Now, and then so there's that on the flipping side, but also on the real estate investing side, you may have cash flow from your real estate investing, but your income statement, because of depreciation and also cost segregation, maximizing your depreciation. And also, when we do your tax return, you're going to see a loss. So it's going to require a deeper analysis to understand, is this really profitable? Is this making sense? Am I building wealth? And here's another thing that a lot of people may be missing out on. Let's say you invest in real estate, and hopefully it's cash flow positive. You want cash flow. It's hard to maintain a business that's cash flow negative. However, if you are not cash flow, or the cash flow is minimal, or let's say the cash flow doesn't reflect what you were hoping to get, you're saying, I'm putting all of this hours in and the cash flow isn't nearly what I used to make at my W-2 job. Why am I spending all this energy to only make a couple grand a month? Well, hold on a second. You have other things here that are building your wealth. So you're paying down equity. The property is appreciating in value. You can sell that at a future gain and pay no taxes. You can borrow from it tax-free, and you're building this massive bucket of wealth. So that's another reason that kind of ties back to when we're evaluating our success and our progress and how we're building a future for ourselves. We want to consider all these other valuables and look at our personal, like you said, our personal balance sheet, and look at how much actual value are we creating for our future when evaluating not only the cash flow and not only the cash that's coming in and out, but all of these other factors.
Yeah, and I call it it's the difference between the short game and the long game. And the short game is income creation. Like, we have to pay our bills today. We have to pay our bills this year. And so that's the short game. And we're thinking the short game. So since we're talking real estate, it is like, if I'm if my only business is real estate in this example, then I have to make income this year. So that's part one strategy is what do I do to make my 6 figures or whatever your income goal is? And that's, again, that's going to be flipping if it's just real estate only. And it's learning like, okay, and how many flips do I need to do a year? And it's crucial that you're really tight on looking at all the numbers. Like where I find people lose their ass, like really in these startup, they took a real estate investing course and they do this and they lose their ass. And it's because they're not really taught the importance, like every dollar matters and some of the things we've already talked about. And like you said, also, it's really important to have your tax person as part of your team so you know the tax implications and how this works, because taxes aren't clear when you're first getting started. So to have that team, like have you on their side, is really important as you're really navigating and assessing each potential deal. So that's the short game. It needs to be strategic. You have to know your numbers and you have to have your team and your partners on board and be really in sync and tighten that relationship. Otherwise, it's so easy to lose a lot of money. And if you lose a lot of money on that first deal, that's going to keep you from doing the second and third and be like, this isn't for me. And I see that all the time, which is some of why I have an objection to some of these online courses where people spend 25 grand, take this online course, do all the things. And it's like, oh, this isn't as easy as I thought it was. But yeah, you might even lose some money on your first deal, and that's part of the learning curve. No big deal. But you can protect yourself from that by just asking better questions and watching the numbers to be more prepared. But the second piece is the long game. And that long game answers the question of like, and again, if we're just in real estate, how many pieces of real estate do I need that can cash flow, let's say 24,000 a year? Or, as an example, how many do I need over a period of time? And if I have 20 years to do it, how many properties am I going to buy over 20 years? And like you said, no, that $2,000 a month isn't going to pay the bills this year, but you keep doing that times 10 and it's going to pay the bills. But like you said, you can flip out of those when you have it for 10 years, there's a big gain. You can sell that 1031, put that into a different type of real estate asset, maybe multifamily or something, which amplifies even that. So that's the long game. That real estate, those are going to grow in value. Most likely real estate's had the biggest gain, crazy gains, in fact, by those of us have held for a long time. And I do that. Like I'll look at, be like, hey, I've really depreciated this piece of real estate. I think it's really maxed out what it's going to do. I can 1031 and flip out of that. And this one's going to have a lot more upside. This going to outside. I've already really optimized the upside of this investment. And you can just start building your wealth that way. But again, that's a long game. I don't know how real estate's going to be in 10 years. But when I get to that 10 years, then I know what I'm working with. But that's that long-term strategy. And like you said, there's so much depreciation that you get to put on your tax return and so many expenses you can really pull out of those that really affect taxes also. And I say never go into investing or business for tax reasons, but you always want to use the best tax play to optimize, your how much money you get to keep in your pocket. So real estate just has so much opportunity, but that's the long game. And that's reaching out like with the end in mind. How much wealth do I need from these different properties that's going to provide that passive cash flow that ultimately I don't have to flip houses anymore because my asset base is now taking care of me. And when we can really focus on and be strategic about the short game and the long game at the same time, that's where you win. And that's where I love real estate, because it can be such a big win by being very strategic in both of these, ways of thinking. And go back where we started, one's an income play and one's a wealth play.
Yeah, and we've seen different strategies where, and where some folks will have investment vehicles where all of the profits are put back into the renovations and back into the renovations. In order to maintain some cash, some liquidity, they'll do a refi, but you don't see a ton. This is not every strategy, but one strategy we'll see is that, and you don't see a ton of amazing cash flow in this thing. But once they've done the renovations, raised rents, and created a very stable, functional investment, now the cash flow is coming in, and now you're going to expect some really good profit in the future years. And some folks, again, thinking about the long game here, that's their goal is that, maybe some of the earlier years, you might take a few hits because you have to invest and fix it up and fix the systems in some of these larger multifamilies in particular. But then as the years go on, you can raise rents, and the rents go up and up and up. Your equity increases and your efficiencies increase. And we've also seen some investors where their strategy is before the cash flow really starts to pay for all of the prior year investments, they've had enough of a success. They've shown enough improvement in the property and the values and fixing the rents and the systems and reducing the unnecessary costs, and they can sell it at such a strong of an exit that with the long game, there's going to be significant gains in maybe a 6-year exit with some of those folks, and then there's all these other ways that we can eliminate the taxes on that with some capital gains planning too. But that's not what you should do. I'm just saying it's one of the things we've seen as a strategy, and obviously you need your cash flow. You really want to have a sustainable business here where cash is coming in.
Yeah, and again, there's different strategies for sure, and you find the strategy that works for you. And if I've done that exact strategy. I mean, a few times in my career where it's like I did a refinance and pulled it out and was able to buy another piece of property, and with that, you really have to watch the market. I've done once where, I bought at the high, I think this was like 2007 or something, then everything cratered. And, so there's market variability and stuff, and hopefully you're protected. And, I've built in some rules for myself that, I only pull out up to a certain maximum amount. So if there's a dip or something, I hopefully can still pull out without a big loss. But there's all the different strategies, but the point here is you have to go in being very strategic and knowing what is the end game here and what am I playing towards, and how do I maximize both these at the same time. And in the long game strategy, like I said, the long game means you're buying and holding for at least 10 years in most cases, because it's going to take that 10 years unless you're in a unusual market like we've been, maybe the last few years in a way. But I've seen, I've been doing this now for 30 years. And so I've been through the 2008 crash, and I've been through actually 2000 crash. There's like a 2008 crash, and then a little bit of what's happened recently. And, I just say those, when you're following those in real estate, make sure they've been through a crash or two, because we've all learned lessons along the way. And those of us that have, still wound up with a significant amount of real estate wealth, we've learned to navigate the markets and what to look for. And I found so many people that were teaching real estate investing before we had this latest downturn, and they're not speaking anymore. They got crumbled because they'd never been through a down market before. So I just say, as you're starting this out, just be careful who you learn from. Make sure maybe they have a gray hair or two. They're very successful over this. They've done it for a long time. They've wound up, they have a $10 million plus portfolio, and they're gonna teach from wisdom as opposed to just sheer youth opportunity and current market conditions.
Yeah, it's good. It's great that you pointed out, because we've seen this, and we've seen this in some of our clients where they quit their jobs, they came in just at the right time, and there was so much appreciation and wealth creation just from being at the right place at the right time. It just looked so easy. And now that they're full-time real estate investors and things aren't as easy as they used to be, a lot of them are struggling to pay their bills, and they're over leveraged, and it's been very challenging for some of these people who have had to find out the hard way that maybe their systems in place weren't what they thought they were, as good as they thought they were. Now that it's not so easy. So we've seen it firsthand with some of our clients, exactly what you're talking about. It takes, you gotta go through, you gotta in anything, you gotta take some L's and really experience some of these hardships, and when things are tough, and survive those tough moments to really strengthen what your abilities and what you're good at.
Yeah, with that too, what some things that you learn along the way, for example, is that when I was young, I did over leverage, and I hit a down market, and I realized the pain of that. And so I don't over leverage anymore. I have my rules for the amount of leverage that, or equity basically in any deal that I might borrow up to that amount, but I'm going to have that buffer that's going to build in some, because none of us can predict the markets. Otherwise, obviously we'd all be bazillionaires, and the markets surprise everybody. So you learn to, what your own rules are and create those for yourself. And, that semi-conservative approach is why I am sitting on, a lot of real estate and a lot of wealth and haven't been crumbled, where a lot of my, I'd say, peers in essence, kind of building at the same time, went fully bankrupt and found themselves in very dire financial situations with some of the bigger market corrections in real estate. But there's that piece. And then it's also understanding that it's not a fast game. that where I find the most risk is out of this get rich quick type of mentality, and real estate's the way to do it. And when you can approach real estate very methodically, and like I said, just this long game, I'm in it for the rest of my life type thing, and I'm going to build this fortune over time, you'll be less risky. You'll because you're just not trying to get rich quick. And so there's that piece. Another thing that you learn is that you always want to have a certain amount of liquidity sitting around. So liquidity matters, and liquidity is the opposite of being over leveraged. And it's just making sure you have, especially because your real estate business is a business, but you want to make sure that in your personal finance that you have 6 months of liquidity sitting there in a rainy day, or whatever word you want to give it. And you have money so that if you have to navigate markets or navigate a deal was just a bad deal, which that happens. Sometimes you get in the business with the wrong person. Sometimes there's a deal I'm in right now where one of my partner, he's my builder partner in Austin, and we bought this piece of property, and it was just all the numbers were amazing. And the numbers are still going to work out, but we're not going to make as much, because the city of Austin changed the codes right before we went in to get our approval to build onto this property. As an old house, perfect part of town, central Austin. And the code changed, and we had to do all this extra stuff. And it wasn't just an extra, $75,000 of money that we'd had to correct these things, that the code wasn't that way 6 weeks before we decided to do this. But then also we had delays of about 9 months of jumping through all these hoops. And so it's ending up probably costing us. Now there's a really nice return on this if it flips out the way it should, assuming nothing else changes. But still, there's $200,000 of profit that we lost just by code changing. Now imagine if we were leveraged to the hilt and we didn't have the ability to navigate this one deal could really sink somebody. So having, the extra cash, having some different things, it's really important to have, even if you're maxing out leveraging maybe this specific deal, it's important to have liquidity sitting around in other places if you need it. There's another deal that I'm in, and this is it's a little bit more of a syndicate. It's a small group of investors where we went in together and buying a piece of a building in Brooklyn. And so we put the money in, and same thing, numbers. We've done this a number of times. And then all of a sudden, the market changed a little bit before we, we're buying this deal. Obviously, we're borrowing, and we were going to renovate this building. And same thing, there were delays, some code change, all these things that we'd done this 10 times before, but this one deal. And so we all had to put in extra money to keep the reserves and to keep it going because of the delays. So if all the investors didn't have that extra money sitting around to recapitalize what some of these deficiencies are. So you can see just how quickly, even as seasoned investors, sometimes you find yourselves in situations that are unpredictable, and you have to have the ability to navigate those. And that's why it's not as easy as it looks like on TV.
Yeah, absolutely. Tell us about some of your biggest wins that you've had implementing your principles and relying on some of your experiences in personal finance and wealth?
I mean, my biggest wins have been buy hold. And that's where it's the antithesis of get rich quick, it's get rich slow. And if you have a get rich slow mentality in real estate, you can get rich. Those that follow a get rich quick mentality in real estate, I found more people losing their asses and, just really creating, havoc in their financial situation. And a lot of those, I mean, it's not rocket science. I bought well. I wrote out even some, I was able, because I wasn't over leveraged, I was able to write out just the dips in the market, even serious dips, and hold on to the real estate. And, cash flow would go way down. Some I had to even, we're in the negative for a little while, but because I was liquid, I was able to keep those going. And then, I'd have multi-million-dollar exits when I bought the property really well, 10 years before, rode through a low when everybody else had to sell at the low. I was able to ride that out and sell at a high. And then, several $1 million able to flip out of the property, 1031 that, take some money, shave 20% off the top, have, really nice boost to lifestyle and whatever I wanted to do there. Put in the other 80% gain in a 1031, paid some little taxes on the money I took out. But, 1031 that in, bought the next piece of property, and then you do that again. And, when you have a whole portfolio of assets that you can kind of, rearrange on the chessboard in a way, then you do that and you can retire in real estate. So I love real estate. I've built my fortune on real estate, but again, it wasn't fast. It was slow.
Yeah. So, and that's the amazing thing when you play the long game and now you have capital gains instead of ordinary income on these long-term buy and holds, a lot more opportunities on the tax planning side. You mentioned earlier holding a property for 10 years. We may be losing this opportunity soon if they don't update the tax code, but one area we love to see people hold for their real estate for 10 years of is qualified opportunity zone funds. And if you have boot, is not the worst thing in the world from your 1031s. If you have some money that you pull out of the deal just so you can have some cash to live on, you could pay taxes on it. Or maybe you can't find enough of a value in replacement property, so you have some potential boot, what we call it, which is taxable. You could put some of that into a qualified opportunity zone fund or something else as well. And sometimes we'll see clients invest in oil and gas if they have ordinary income, which is a really fun strategy with some of their cash. But lots of fun things you can do with capital gains tax planning. Krisstina, can you tell us a little more about what your project is, what you offer to people, and if they want to learn more, what can they do to explore these concepts and work with you and tap into all of your knowledge and wisdom that you acquired over the years?
What I do is I help people really develop their relationship with money and learn how to count it, learn how to look at it on the books, learn how to manage it, and really learn a profit first system for how to create wealth and understand the difference between income and wealth. Like we talked about, how much money is enough, how much income is enough, what's the cost of my lifestyle, how do I manage my expenses, how do I manage my expenses relative to income, how much profit is enough, and just really getting a look, understanding the money and really understanding the numbers from a non-accounting way. So, even like I said, I started accounting and I found accounting was really boring personally. I didn't like to be in the books all the time. It wasn't me. I just thought, why did I study this in college and do all these things when I don't like accounting? And from that, so I think what gets in our mind is that I don't like accounting either. As a business owner, I want to give my money to the accountants and then to the tax planners to let them manage that for me. And I say, no, there's a difference between kind of business and personal money management and understanding your money and giving every dollar a job and making sure that money's covering all the places in our life that we need to cover. And we know our own numbers. We know our own how much money is enough. And then we work with the accountants and the bookkeepers and the tax planners to help us optimize what our money that we're accountable for. And so that's what I help entrepreneurs and investors do, is to understand their money from a more intimate level and appreciate the fun side of accounting and give the boring side of accounting away to the accountants to find that stuff not
Guys
boring.
like us, the masochists of the world.
Exactly.
Awesome.
That's
So
right.
what's your site? We'll put it on our show notes just so the listeners can say, hey, when they hear you and they want to learn more about you, where can they go?
Really, where I'm putting everybody right now is my YouTube channel, because I'm teaching a lot of this, what we're talking about today, and just very practical sound bites to help really any of the listeners, especially investors and entrepreneurs, really understand money differently, kind of what I call from the inside out, and to start to learn this different mindset and management styles so that we can create wealth while we're building our businesses and really optimizing and increasing our income. So that's just at Christina Wise at YouTube with my unique spelling of my name. So yeah, pointing people to YouTube. And otherwise, I have a podcast that's called Wealthy Wealthy. And I'm interviewing those like you. You'll be on my podcast, for example, where I'm interviewing other experts in all categories of money, so that again, we can just, my goal with the mission of my work is just really help us to be educated and knowledgeable when it comes to money in every aspect of it, and really learn to love it, manage it, grow it, spend it, build it, share it, all the different pieces. But when we're uneducated about money fundamentals, it's just really easy to find ourselves in the constant chase of more money, being dissatisfied, finding ourselves in really dire financial situations, having a lot of financial conflict at home, so on and so forth. So that's the problem I'm trying to solve, is just the lack of understanding of how money works.
Wonderful. Okay, thank you so much, Christina. And you said with the last name, it's Christina with two S's, and is Wise, Wise. If you search her, and obviously this will all be in the show notes. Thank you so much for your time today, and we're very excited to share this with our audience. And if you have any other questions, just reach out. And this is a really important topic you guys got to start thinking about with building your wealth. It's not all about reducing your taxes. It's just one element, and we got to think about the long game here, and having a deeper, more connected relationship with our money.